It's the Wednesday edition of Market Call. I'm Michael Hainsworth. And for the next half hour, Jeffrey Olin, President and CEO of Vision Capital, will be taking your questions on Canadian REITs and real estate operating corporations. You can call us toll-free right across the country. 1-877-667-6288 is on my dime. If you're in Toronto, dial us direct at 416-957-8199 or send us an email, marketcall@bnn.ca. Jeff, welcome to the program.
Thank you.
Tell us about Vision Capital, your vision.
Vision Capital was founded by my partner Frank Mayer and myself, and we focus on investing primarily in publicly traded real estate equities with a focus in Canada.
What is it about real estate versus any other form of equity in this country that's available that appeals to your corporation?
Well, first of all, it's an area of great expertise, knowledge that Frank was a top-ranked analyst for 35 years, and I had a 25-year career with a focus in real estate. So we know the space well, but what got us to launch our fund in 2008 was a persistent inefficiency in the pricing of real estate securities in Canada. Sometimes too high, sometimes too low. And if you know what you're doing like we think we do, you can take advantage of that.
Tell me about which of the plays in the space are you most comfortable with right now? Commercial, retail, residential? Where's the low-hanging fruit, I suppose?
We've been cautious in our outlook, and that's tended to have a bias towards the residential sector where there's been absolutely no issue in raising debt capital. We have the blessing of CMHC in Canada. Canada Mortgage and Housing Corporation provides government-guaranteed insurance for mortgages, so you can get an abundance of capital cheaply. We're more stock pickers, so we will look at various sectors, and we have investments in a number of different sectors, including commercial, but we have an overwhelming balance to residential at the moment.
We're in a rising interest rate environment, although not a substantially increased interest rate environment. Yet at the same time, our economy isn't expected to grow as fast as first thought, either this year or next. So how do you balance that out when you look at that retail side, at that commercial side? How are those spaces handling those issues?
Well, you got to be careful with interest rates because it's hard to make a judgment in looking at interest rates alone. I mean, are interest rates going up because it's an inflationary environment? That's good for real estate. Real estate's a hard asset, so if it's an inflationary environment, it's good for real estate. Are interest rates going up because there's a credit crisis? That's bad for most businesses, including real estate. But the Canadian publicly traded real estate equities are extremely strong balance sheets right now. They're not over-leveraged. They have good coverage ratios, and they have longer-term mortgages. So we have, record low interest rates, but they can withstand operationally to have an increase in interest rates, and over time it shouldn't have a material impact.
I can't imagine you're that worried about inflation at this point anyway.
We don't see a major inflation risk at this juncture, no.
All right. What do you say we take a break, come back, take some calls?
Perfect.
All right. Jeff Olin's here from Vision Capital, and of course we're focusing today on REITs and ROCs. Give us a call, toll free at 1-877-667-6288. In Toronto, 416-957-8199 or market call at bnn.ca. Jeff Olin's here from Vision Capital. We're talking REITs and real estate operating companies with Michael in Markham. Welcome to the program, Michael.
Very much for taking my call.
You bet.
My question is about Extendicare, exe.un, and just trying to get some more news on an investigation in the U.S. into some of their billing practices, and is it a buy, sell, or hold? And I'll hang up and listen to the response.
Well, inherent in your question somewhat lies the answer. We're familiar with Extendicare. We've never owned it. We don't own it, and we'd be reluctant to own it simply because they're in a very specialized area, nursing care, but more significantly, which is we have nothing against nursing care, United States. 70% of their operations are United States. It's a very volatile marketplace in terms of Medicare, Medicaid. The formulas change. It's a very litigious environment, and Extendicare and others have had challenges and minefields in that space. So if you're looking for a name in that space, we have a Canadian name that's focused in Canada Leisure World. It's a recent IPO. It's got a 9% yield. It's a dividend yield, so you enjoy the dividend tax credit. And we would tend to see that as being a much less risky way to play the nursing care space.
That nursing care space as well, very difficult too, because not only are you dealing with the real estate component, but then you've got that other issue of the recurring costs associated with the care in and to itself, and it's a hybrid, really.
Absolutely. Like hotels, nursing care is primarily an operating business. You can do the best real estate deal in the world, but if you got a lousy operator, you're going to lose money. So you've got to recognize that in those kinds of investments.
All right, Michael, thanks for that. From Markham, we're off to Dave in Toronto. Hi, Dave. Welcome. Dave, are you with us? All right. Oh, I can hear you barely. Welcome to the program.
Artis REIT?
Artis.
Yes.
Artis REIT is a strong management team. They're Western Canadian-based, commercial REIT, diversified. High growth. The management team has been involved in the real estate space for some time. We've encouraged them to increase their ownership. They have. It has an attractive yield and is relatively attractive valuation because of their exposure to the Calgary office market. Mm-hmm. And while supply and demand fundamentals are outstanding, generally speaking, in Canadian commercial and residential real estate, one soft spot is Calgary office. I think Artis has been diversifying to somewhat and can withstand that. Great REIT. We don't own it at the moment.
You don't own it. Tell me about what you would expect, though. The quarterly results come out in the middle of August, about the 11th, actually. Considering what they're dealing with in Calgary and broadly speaking in the industry, are you expecting these guys to be able to outperform, underperform, or just sort of hit market expectations?
I think they'll be in line with market. We're not studying this closely at the moment. We don't own it, but...
what would it take to make you study it a little more closely? What needs to be attractive to you?
We look primarily, our principal valuation metric is net asset value of the underlying real estate. So what's it worth on a value of the real estate, and then add the operational, because real estate entities, one of the reasons we have a stock market is it's much more than a collection of bricks and sticks. So we look at management teams, we look at alignment and ownership, but a key metric we look at is net asset value, and we see opportunities where names are trading at substantial discounts in net asset value, and that's what we focus on.
All right. Thanks, Dave, for that. George in Regina, welcome to the program. Hello.
Thank you very much. Most of the trusts have to convert at the end of the year. Does that also include the pipeline trusts? And also, because people are looking for yield before the end of the year, do you think these REITs are going to become more popular before then? Or have they made their move already? Thank you.
Well, firstly, I confess, while I have some generalist capabilities, I'm not an expert in pipeline trust, but my understanding is that it's only the real estate space and non-operating entities in the real estate space that will be exempted from the SIF legislation. So clearly that's an advantage for REITs that qualify, in that there will be sort of the last game in town in terms of tax efficiency of the structure. We have already seen a money flow, I think, into the REIT space because of the SIF legislation at the end of the year, and I think you will continue to see that money flow as being an attractive, stable, and safe place to get income and yield.
Do you think, though, that broadly speaking that the REIT valuations already take into account an expectation of a shift from traditional income trusts into REITs come 2011?
To some degree, but I don't think it's over yet.
All right. Thank you for that, George. We're off to Perry in Toronto. Hi, Perry.
Good afternoon, Michael.
Good afternoon.
Gentlemen, could you give me your view on a 3 to 5 year of the Callaway REIT?
All right.
Thank you.
Well, Callaway, for those that aren't familiar with, is focused in the retail arena. A lot of large format or big box stores, centers. They have an alignment with Smart Centers, which was a source of many of their centers. Good management, very high stability. The principal shareholder of Callaway brought Walmart to Canada, so they have a lot of Walmart-anchored shopping centers that provide stability to the REIT, reasonable yield. There was some concern earlier or last year about their debt refinancing. I think that's been put to bed. They did an equity issue this week that was well subscribed. The REITs come back a long way in terms of pricing. It's a large cap, good quality REIT.
You point out that it's also anchored. A lot of them, those smart centers, et cetera, are anchored by Walmart. You know, there was the 80s and the 90s where the major chains were operated and run with a theater in them, and then that waned. An arcade, that waned. Is a Walmart type environment far more sustainable than what we had seen previously?
I think so. It certainly provides a stability, and you may not make a lot of money out of the Walmart tenancy per se, but it's an anchor for the rest of the center, and it's an anchor for other centers in the region. So it provides stability, and you've seen it with Callaway being able to maintain their occupancy and release in this few instances where they've had some vacancies come up. So there's some stability. I mean, Canada is blessed with a collection of very high-quality retail public entities, and Callaway's one of them. First Capital, RioCan, even the small cap Plaza Corp. I mean, there's a number of them, and each one has a little different niche, and Callaway has theirs.
Would you prefer to invest in a company that is an unenclosed environment, like the smart centers are, where you've got the parking lot in the middle and everybody around it, versus your traditional enclosed, which has a higher overhead? Absolutely.
There's no question about it. You've seen a stability. I mean, you mentioned Callaway. I mentioned First Capital. I mean, First Capital focuses, their religion is grocery store and pharmacy-anchored shopping centers. That irrespective of economic cycles, people have the basic necessity of life that they need to shop in, and it provides a stability, and there's a much lower cost to your specific question of operating, because you don't have the common area maintenance costs that you do in the Yorkdales.
Do you own a Callaway?
We don't at the present time.
All right, 7.2% yield for you, Perry. Thank you for that. We are taking a quick break. When we come back, Jeff Olin, President and CEO of Vision Capital, taking your questions on Canadian REITs and real estate operating corporations. Jeff Olin's here from Vision Capital, and we're talking about REITs and real estate operating companies. Daniel's in Toronto on the local line. Hello, Daniel. Welcome to Market Call.
Hi, Michael. I'm calling about a little bit of a train wreck. It's Lanesborough, LRT.UN, and I'm thinking of transitioning everything I have in that towards EDU, Edleon, and I know they're sort of real estate related. So if you have any comments about Lanesborough or, I guess, the transition. Thank you very much.
Well, we know both situations very well, and I'll probably save my comments on Edleon for a few minutes because it happens to be one of our top picks. So clearly we like that situation a lot and know it well. Lanesborough we also know well. Lanesborough is basically a bet on Fort McMurray. They have a heavy concentration of apartments in Fort McMurray. They're decent quality. You've toured many of the properties. The REIT got into trouble. You called it a train wreck because they had a high quantity of high-cost debt, and they needed to sell and have been in the process of selling assets to deal with their debt problems. There's a lot of upside leverage if Fort McMurray comes back, and it is coming back to the levels that it was at, and they get their debt problems under control. It's a high-risk, high-reward situation.
Okay. They don't even have a distribution at this point.
They did. They eliminated the distribution to help manage their balance sheet.
So at 44 cents, high risk, high reward, but would it be something that you'd be willing to own?
We have a small position in some debt, secured debt, and some warrants there. We don't have a position.
Is that the better way to play it, playing the bonds essentially?
If you can acquire them, and it's a more secure way to play it. But if you believe in Fort McMurray and the story, there's a lot more upside in the equity. But it's a high risk situation. All
right, Daniel, thank you for that. And again, you'll want to join us in less than 10 minutes' time because your alternative play there is in fact one of the top picks. We're off to Sarnia now for Bill. Hi, Bill. Welcome to Market Call.
Hello, and thanks for taking my call.
You bet.
If I get your guest views on H&R REIT, would he be a buyer at this price, and would he have a target? Thank you very much.
All right.
Again, H&R is extremely high-quality REIT. It's a large cap, one of the first granddaddies of the REITs. Strong management. The management team is not as aligned as we would like. We like management teams that own a lot of units and are internal. And while management owns some units, we think they could own more, and we'd prefer to see an internal structure. We have owned H&R. H&R struggled because of exposure out of left field to the Bow development in Calgary, which was 100% leased to TransCanada, AAA tenant, but they didn't get their construction financing. It was under pressure. We owned it at that juncture. They solved all of those problems. The REIT's in good shape. It has a reasonable yield. There's a prospect of a distribution increase over the next 12 to 24 months. It's trading in the range of its net asset value, so it's not one of our holdings at the moment, but it's a stable quality name.
Tell me more about management putting their money where their mouth is. What percentage of the company do you want to see a management team owning before you're willing to say, okay, they've got their penny in this game, I'll put mine in too?
It's difficult to answer that in static. As much as possible is the answer, and it depends on the substance of management. You don't want to be punitive to outstanding management that just may not have the financial capacity to own a lot. So really, we make a judgment in the context of the specific situation, but in each one of our top picks, as you'll see, management has substantial ownership in some of our other holdings, and we like to see that.
In the meantime, you figure that 4.6% yield could go up, that 7-cent distribution increased?
I think it will go up.
Where do you see it a year from now? You're not going to crystal ball it for me? All right. Not a problem. Thank you for that, Bill. We're off to Roger in Fraser, BC. Good morning to you, Roger.
Good morning. I have Temple REIT, and I'd like to know what your opinion is of their sustainability for their dividend and future growth for the company. Bought it at lower than what it currently is, and is it a buy or a sell?
All right.
I'll hang up and wait for your response. Thank you.
Thank you.
Well, Temple, to a lesser degree and certainly less severe circumstances, the hotel equivalent and had some common management to Lanesborough. They have a heavy weighting to Fort McMurray and Western Canada. So that suffered as that marketplace deteriorated. It's on the rebound. Again, I've toured a number of their hotels. It's really Fort Mac Hotel, so it's a bet on that region. And if you feel strongly that that region is continue to do well, we're quite bullish on the region and oil sands in Alberta generally. There may be some upside there, but again, it's very concentrated in that area, so hence there's some risk there.
It has a 15.6% yield right now. It's a dime distribution. Does that double-digit figure tell us that the market's expecting to see a cut to that distribution?
Well, it tells you that they're overpaying. It doesn't tell you, but they are overpaying their distribution, and it tells you there's some caution. Again, they've had some shorter-term debt obligations they've had to resolve. They've done a reasonable job to date in doing so. Again, there's some upside to that name, but it's a risky name.
Buy, sell, or hold, as far as you're concerned?
We have some of the debt there, but we don't own the equity.
All right. Thank you, Roger, for that. From Fraser, BC, to a commercial break. And when we come back, we'll go to northern Georgian Bay, Ontario. We'll talk about one of the big plays in the space. Time now for the top picks from Jeff Olin at Vision Capital. Top pick number 1, PRK, Park Bridge Lifestyle Communities. Why?
Why? This is a unique business and a unique business model. They're in land lease communities. What does that mean? It means you go and you buy a prefabricated manufactured house with your money, and you go to Park Bridge, you put it on their land, and they charge you land rent. It's like the apartment business, but better. Better in the sense that whereas apartments are gross rents, you pay your monthly rent, $1,500 a month, that's what you pay. This business is primarily net rents, where the homeowner pays the operating costs and realty taxes. It's
trailer parks.
It's you could put that adage on it, but one of the reasons why it's good value is you look at these homes. Some of them have basements, single families. They're in 40 by 100-foot lots. They have tennis courts, community centers. They're retirees that have a place in Florida, north. I mean, this thing has got the most pure form of cash flow in the real estate space.
2.9% yield, not the richest yield in the business. So are you also buying this for stock price appreciation?
Yeah, I think that, again, a general comment that's important to get out there is investors need to look at real estate on a total return basis. You'll see one common thing amongst our holdings, top picks. This is the only one with any yield, and they recently put it in. The beautiful thing about real estate has an opportunity to pay a yield. Whether they're currently paying a yield or reinvesting that cash flow for higher growth, and you're going to get capital gains, which can be more powerful than yield, is what you got to look at, and that's what we're looking at here.
Topic number 2 is Main Street equity. Street consensus is this could climb 40% in the next 12 months. Is that a reasonable expectation?
Well, like Parkbridge. I mean, Parkbridge we see trading at a 30% discount to its net asset value. Main Street we see trading at 40%. They're in the apartment space. It's a unique entrepreneurial model. The entrepreneur has grown this company from 300 units to 65 units with a net equity contribution of $10 million. So they focus on mid-market properties above the mom and pop, below institutions that are beat up, that need physical or operational improvements. They do it, and they do a great job of it. They refinance it. They take their equity out. It's got a net asset value of $16, $18. They have $50 million at cost. The property's unencumbered, so there's probably $5 a share in cash potential from refinancing their existing properties.
Topic number 3, as we were discussing with Daniel in Toronto, EDU on the venture.
EDU is our newest investment. We're the largest shareholder in the company. I'm on the board of directors. We're extremely excited about it. They just raised $40 million. They're a consolidator of the child care industry in Canada, which is the last Anglo-Saxon country on the planet that hasn't gone through a consolidation. Morgan Stanley and Bain bought the 2 largest U.S. public companies at 12 times EBITDA multiples without the real estate. Edlian is buying at 6 times EBITDA with the real estate. We were involved in 2 consolidation plays, Boardwalk and Killam, earlier in our careers. We see, and they were 5 to 10 times return on investment. We see the same types of potential here with Edlian, outstanding world-class management that have come from the United States and Australia to do this.
What's the end game here? Is this a company that ends up being acquired itself? We know that there are major players in Australia and elsewhere around the world who are looking in Canada and in North America generally.
At some stage, and that's certainly one of the exits, we see a substantial growth before that occurs. I mean, the challenge is it's a lot of hard work to consolidate these mom and pops. I mean, the 5 largest operators in the country own less than 1% of the universe. So for a big private equity, they can't get scale. Edlian certainly is providing that scale. And by the way, dissimilar to Boardwalk and Killam, Edlian has benefited by the fact that there's a severe shortage, and they'll be doing some new child care centers and creating a new standard of professionalism and nutritional programs, educational curriculums, so doing a community service at the same time.
And again, for the purposes of disclosure, you are on the board.
I'm on the board, and we own just over 10% of the company, and we're very excited about this story.
All right. Jeff, thank you so much for joining us here today.
Thanks very much.
Jeff Olin, President and CEO of Vision Capital, has been our guest. If you miss any part of the program, bnn.ca for the replay. And as always, please consult a qualified financial advisor before making any investment decisions. For Howard Green, I'm Michael Hainsworth. Thanks for joining us. Hope you'll be with us next time.